Midnight. Phone glow on the ceiling, Zillow scroll, 2-bedroom box, 500,000. You do the mental math and wonder. U.S. median sales price, 403,000. Median listing, 425. Median income, 83. 6 times income. 18% of U.S. households earn 150 plus. Census ACS 2023. The approval pool is small. The bank says approved. Your gut says no. Reference-dependent preferences, Kőszegi Rabin. 2006, loss aversion. 6 blocks, every dollar cited. By the end, you'll see the honest cap and run your math tonight. Let's go. I'm Frank. Every number in this video has a source. Fred, Census, Fannie Mae, CFPB, Tax Foundation, Insurance Information Institute, Harvard, JCHS, 2 cited papers. Links below. Let's pull the trick apart.
Block 1. The real cost. A $500,000 home is not $500,000 a year of your life. It is principal, interest, taxes, insurance, maintenance, and the poverty tax called PMI. We stack each one from sourced numbers.
Start with the loan. 10% down, 50,000. Most people don't have 20 down. Fed SCF median savings is around 8,000, so most people borrow 450,000 at today's rate. Fred mortgage, 30 US. The Freddie Mac, 30-year fixed weekly average week ending, May 21st, 2026, 6.51%. Run the amortization on 450,000. Monthly principal and interest, $2,844. Property tax. Next. Tax Foundation 2024 U.S. median effective property tax rate 0.99% on a $500,000 home, $4,950 per year. $412 a month median. New Jersey doubles it. Hawaii cuts it to $130. Homeowners insurance. Insurance Information Institute 2024 U.S. average $2,377 a year, about $198 a month. In Florida or California climate risk zones, 3 to 4 times that. Premiums up 59% in Florida alone the past 3 years. Maintenance. Harvard Joint Center for Housing Studies, 1% of home value per year is the floor. 1 to 4 depending on age on 500,000, 5,000 a year minimum, $417 a month. The water heater always dies on a Sunday at 11 p.m. Frank at the whiteboard. Principal and interest, $2,844. Tax, $412. Insurance, $198. Maintenance, $417. PMI coming already at $38.71 a month. We're not done. Block 2. The poverty tax. PMI, private mortgage insurance. The fee you pay every month because you weren't wealthy enough to put 20% down. The insurance protects the bank, not you, when you might default. Fannie Mae and Freddie Mac standard PMI rates, 0.5 to 1.5% of the loan amount per year. On 450,000 at the midpoint 1%, $375 a month. At 1.38% typical for 10% down, $518. Add $518 to $38.71. True monthly cost of a $500,000 home with 10% down, $4,389 every month, 12 months a year, for 30 years if you don't refinance. And that's the floor. Before HOA, before the roof at year 12, before the HVAC at year 10, before the credit card that runs hot every time something breaks, before the property tax appeal that takes 8 months, just the steady state monthly. Now run the affordability rule. Fannie Mae Underwriting Guideline B36. Front-end housing to gross ratio, 28% maximum. Not opinion, not financial advisor preference. Actual GSE underwriting standard. 4,389 divided by 0.28. Multiplied by 12. Required gross household income to afford a $500,000 home, $188,000 a year, per the 28 rule. But the bank says you can stretch. Consumer Financial Protection Bureau Regulation Z, Section 1026-43. The Qualified Mortgage Rule. 43% back-end debt-to-income ratio. The legal maximum for safe harbor loans. At 43% DTI, you're using almost half of your gross income on debt service before food, gas, kids, or savings. Bank's risk model says this won't default immediately. That's a different question from whether you can live a life. The bank stops at won't default in 6 months. You stop at can I take a vacation, fix a break, replace the dishwasher without a credit card? 2 different math problems. The bank's math is solved at yes. Yours starts there. Frank at the desk. The number 4389 underlined 3 times. The number 188,000 circled below both, a single question. Does this fit the life you wanted, or only the loan officer's spreadsheet?
Quick aside before Block 3, the bank's risk tolerance and your ability to live a life are not the same calculation. They never were. The system is designed to get you into the house, not to ensure you can comfortably afford it long term.
And once you've signed and moved, you're trapped. You can't decide in 6 months it was a mistake and walk away without destroying credit and losing the down payment. So people stay and quietly drown. We're going to do the math on staying versus walking. Frank at the whiteboard, 2 universes drawn, A on the left, B on the right. Same family, same Friday at the listing, 1 signature apart. Let me show you the math that splits them. Block 3. The 2 universes. Same household, same 84,000 income, same pay stub, same kids. One signs the contract at 500,000, the other caps the search at the honest math. 7 years out, entirely different lives. Universe A, you took the bank's approval. 500,000 house, 10% down, 4,389 a month. 46% of your 9,500 take home, the rest of your life shoehorns into 5,100. Universe B, same 84,000 household. You ran the 28 rule honestly cap at 1,954 total housing, looked at homes in your honest band, found a $200,000 home in a quieter market. P&I plus everything, 2,400. The difference between Universe A and Universe B every month, $1,989. Universe B takes that $1,989 every month and parks it in an S&P 500 index fund. Conservative 8% annual return, same as the historical average. Future value math, $1,989 a month, 8% compounding, 7 years, $223,000. Not in someone's pitch deck, real compound interest. The math has been doing this for 500 years. It does not care about housing market vibes. Universe A, 7 years later, equity in the house, maybe $40,000, including principal paid plus appreciation, minus selling costs. PMI burn, $43,000 stress. 2 arguments a month about the dishwasher. Universe B, 7 years later. 200,000 house worth $250 after 7 years of modest gains, plus $223,000 in index funds, plus a wedding hotel paid in cash. Net worth gap between Universe A and Universe B, about $200,000. Same income, same job, same Friday, different house. $200,000 net worth gap from 1 signature. Run it 20 years out, Universe B has $500,000 in index funds, plus a paid-off house. Universe A is still paying the bank. Block 4, the Cascade, the expensive house doesn't just cost you the money, it rewrites every other decision in the household. Start with the margin, the buffer, the thing financial advisors call breathing room. You don't have any. After $4,389 in monthly housing, the household making $9,500 take-home has $5,100 left. 2 car payments, $800. 2 car insurance, $250. Gas, $300. Groceries, $800 for a family of 4 eating cheaply. Health insurance the employer doesn't fully cover, $400. Student loans, $600. Utilities for a bigger house, $450. Subtract all of that and you have $1,500 left for everything else, including emergencies and savings. And kids. Emergency fund death. Personal finance baseline. 6 months of expenses saved, about $36,000 for this household, at $1,500 a month margin. Theoretically 2 years, but the margin disappears. The first month the AC dies. The first major repair. HVAC $5,000, roof spot $3,000, sewer line $8,000. Average homeowner hits an unbudgeted 4-figure expense every 18 months. Without a fund, each one becomes credit card debt at 23% interest. Within 2 years, you're carrying $8,000 on credit cards, $160 a month, pure interest, money you pay to the bank for the privilege of having bought a dishwasher in the past. The expensive house didn't just take your monthly, it took your future cash flow too. Career trap. Same trap as Block 4 in the truck story. You can't quit the job you hate. The payment is due regardless. You can't negotiate aggressively for a raise. Losing means losing the house. You can't take the entrepreneurial leap. The mortgage owns your courage budget. Lock-in effect. Federal Housing Finance Agency Working Paper 24-03. About 1 in 7/10 million home transactions suppressed in 2022 through 24 because existing owners with sub 4% rates won't sell. Their next mortgage would be 6.5. You're trapped from both sides. Relationship strain. Every financial discussion is shadowed by it. The vacation that didn't happen, the kid's field trip you skipped, the medical bill you almost paid late, your partner suggests selling, you get defensive. Somewhere in the closing day photos, you tied your identity to the house. And the worst trade is the optionality you didn't see disappearing, the sabbatical, the career pivot. The freedom to move when a parent gets sick. The chance to take a lower-paying job that excites you. The mortgage doesn't just charge a monthly fee, it charges every aggressive move you might have made. Block 4, done. Margin, emergency, credit, career, lock-in, relationship, optionality, one signature, 7 domains downstream, and the cruelest part, none of it shows up on the closing disclosure. The disclosure is silent about the life behind it. Block 5. Every counter-argument I hear when I share this math. We're going to walk through 5 with numbers, with cited sources. Run them past your own math the next time someone uses them on you. But rates will drop. The most common defense, maybe. Forecasts say maybe a point lower in 18 months on 450,000, 1 full percentage point lower saves you about $300 a month. Still 4,000 monthly all in. Still need 150 plus to afford it. Math barely moves. And here's the twist: when rates drop, prices go up, same monthly, higher loan balance, different shape of trap. Federal Reserve research published 24. Every 1-point rate cut historically maps to 3 to 5% price increase in the following year. The trap reshapes. It doesn't disappear. Myth 2. Houses always appreciate. Mostly true over 30 years. Not true at the timescales that matter to mortgages. Case-Shiller National Index, 2007 to 2012, down 27% peak to trough, 5 years of negative. Some metro markets 18 years to recover. And appreciation gross is not appreciation net. You bought at 500, you sell at 600 10 years later. Sounds great. Selling costs 6%, 36,000. Inflation ate a third of nominal gain. Net real return after transaction friction, close to zero.
Myth 3. Renting throws money away. Renting buys you optionality. The thing that almost saved Universe B, the thing you lose the day you sign. Rent rises with the market. Mortgage interest rises with nothing. But mortgage operating cost rises with everything. The math is closer than people think.
New York Times rent versus buy calculator, cited methodology, honest comparison on a 500,000 home with current rates and 7-year hold horizon, renting plus disciplined investing wins in a majority of U.S. markets. Not all, but most. The default story is wrong. Myth 4. You can buy now and refinance later. Maybe you're betting the rate environment in 2 to 4 years. You're paying refinance closing costs of $3,000 to $6,000. You're paying full monthly until then. And you cannot refinance if your house value fell. The plan has a fragile foundation. Myth 5. Renting is failure. This one isn't about math. It's about social pressure. Your parents bought at 3 times income. You're being asked to buy at 6 times income. Survivorship bias, of which parents you talk to, most renters in your generation are not failing. They're doing reality math. Each of these counter-arguments was constructed to short-circuit the math at the exact moment you're about to do the math. They're not lies exactly. They're framed to feel true. Cited data is the only thing that holds up. Numbers, sources, receipts, 5 myths, 5 rebuttals. Frank at the whiteboard. 5 myths crossed out. A single phrase underneath. The math is the rebuttal. Block 5, done. We have one more block to go. The why. Block 6. The mechanism. Why does this whole trick work on smart people? 2 cited papers, both available in the description below. First, Kőszegi and Matthew Rabin, 2006. A model of reference-dependent preferences, Quarterly Journal of Economics, published in the top general interest economics journal, 1,890 citations. The paper formalizes how the brain processes options against a reference point. The bank tells you approved at 500,000. That number becomes your anchor. When you tell yourself actually 400,000 is the honest cap, your brain registers it as a loss relative to the anchor. Loss aversion kicks in. You feel like you're giving something up. The dollar amount didn't move. Your reference point did. The bank said it for you. It's not a flaw. It's documented across thousands of experiments. The brain treats reference points as quasi-real. Once the bank tells you the high number, walking down feels like a giving up. The mortgage broker doesn't have to push you. The math your brain does the work. Second paper. Carl Case and Robert Schiller, 2003. Is there a bubble in the housing market? Brookings papers on economic activity. 1,280 citations, the foundational paper on housing market psychology. They documented that home prices in bubble markets diverged sharply from fundamentals: income, rent, construction cost. The structural models that explain prices in normal markets break down in bubble periods. 2026 is not exactly 2005, but the structural disconnect rhymes. When you ask, is now a good time to buy? The academic answer is not when home prices are this disconnected from incomes. Real income grew 28% since 1990. Case-Shiller home prices grew 332%. The gap is structural, not cyclical. This is not malice from real estate agents. It's a market built on social proof and reference-dependent psychology. The cited economists documented exactly why otherwise smart households commit to math that breaks their lives. Knowing about it is most of the defense. Block 6 done. 2 papers, 1 bubble model, 1 reference dependence model. The playbook of why this works on you is sitting in a university library, which means you can read it. You can write the honest cap down before you walk in. 1 sticky note. The honest cap, 28% of your gross income. Not what the bank approved, not what the realtor showed, not what your friend stretched to, your number. Before you let any other number into your head, that's the whole defense. Frank at the desk. Sticky note in front of him says honest cap underlined twice. The number above your gross income. Below that number times 0.28 divided by 12. That's the maximum monthly. The gap to approved is the trap. Let's bring it home. Remember midnight on Zillow? The 2-bedroom box at $500,000? The mental math that didn't add up? Now you know what was actually on the listing. Let me read it back to you, line by line. $4,389 a month. That's what the bank's approved meant. 28% of $188,000 in income, which only 18% of U.S. households earn. Per Census ACS 2023. $223,000 in foregone investment returns. The universe B you didn't take. $200,000 net worth gap between you and the version of you who walked. 7 years of locked monthly anxiety. 84 chances to wish you'd done the math first. 3 numbers to take home. If you remember nothing else, remember these. 1. $4,389 a month total cost of a $500,000 house with 10% down. Real Fannie Mae rule. Real tax foundation rates. Real PMI. Real total. Just the math. 2. The gap between real income growth and real home price growth since 1990. 28% versus 332%. Case-Shiller, Fred, a 4-to-1 ratio. The system rewrote affordability without telling you. Not your fault. Real math. 3. U.S. median home sales price, $403,000, not $500. The $500 is normal, framing as a metro pricing story that became a national assumption. The honest national median is $100,000 lower. Universe B exists geographically. 3 numbers, cited, real. Run them yours tonight. And here's the line I want you to remember. Read it twice if you have to. The bank stopped at yes. Your math should start there. Approval is risk modeling for the bank. Affordability is risk modeling for your life. They're different math problems with different prices. Don't confuse one for the other. 18% of households can stretch to it. 82% cannot. That is not your failing. That is structural arithmetic. Real income up 28. Real prices up over 300. Different decade. Same math. One thing to do before you book the next showing. Open a calculator. Take your household gross monthly income. Multiply by 0.28. That's your honest housing cap. Not negotiable, not the bank's number. Yours. 28 is where Fannie Mae's actuarial data points, where compound interest doesn't drown. If the house you're touring blows past that line, you don't need a different bank. You need a different house, or a different timeline. Every dollar in this video is sourced below. Fred, Census, Fannie Mae, CFPB, Tax Foundation, Insurance Information Institute, Harvard JCHS, Kőszegi and Rabin, Case-Shiller. The links are in the description. The math is yours to verify. Don't trust me. Trust the math. 30 seconds, a sticky note, and the 28% rule. That's the whole playbook. The bank stopped at yes, your math should start there. Math doesn't negotiate. Don't try. I'm Frank. See you on the next one.